All right, so questions before we start? So we are just trying to do some explaining about bonds of different maturities and the values that they have is in general what Chapter 6 is talking about. So you have bonds of different risk but same maturity, or you can have bonds of same risk but different maturity. And so what was the thing that the yield curve was showing? What's on the axes of the yield curve? Interest rate and
time to maturity.
Time to maturity, yeah. So and it's really the maturity of the bonds, like when they're there. So you got to be careful with the time because that's exactly what it's trying to do. And then are they of same risk or different risk? Same risk. So the idea is what's happening with rates of return, expected rates of return on an asset that has the same similar risk, but just simply different maturities. And so the yield curve is generally upward sloping, and that's what we're trying to explain where we left off last time with different theories about why it's generally upward sloping, but sometimes downward sloping. So we're going to wrap up Chapter 6 today, and then we'll be getting into Chapter 7. So here is 1950 to 2015 U.S. government bonds with different maturities. So again, are they moving together or apart? Together. So in general, we've got 20 years the red, 5 years the blue, 3 months. So those are usually called T-bills, Treasury bills. It's just the same thing, conceptually the same thing, but it's just very short term. Those are also moving here. So we see that the green line tends to stay under the red and the blue, right? Which would be consistent with this yield curve concept that longer term stuff has higher interest rates compared to shorter term stuff.
So, one question is, in the 80s, I see it spikes up because it has the market crash in 80s, right?
No, it's more the inflation.
Oh, inflation. I was wondering why in 2008 it also didn't go up.
Yeah, so no, it was inflation driven is what this one was.
Oh.
Mostly. So coming out of the late 70s into the 80s, we had double-digit inflation rates, which we've never really seen in the history of the United States. And so with our Fisher formula, we have the interest rate is equal to
R plus inflation.
R plus inflation, the way I got it here. So we are measuring nominal rates here. And so the real rate, if we were to take out inflation, what would happen to this graph? If we took out inflation, what do you think would happen to it?
It'd probably be a lot lower.
A lot flatter,
Right?
right? So lower this peak but lower. And we'd have a lot more stability. We have other graphs that will do that show if you graph the real rates. So the real rates would have the inflation rate sucked out of it, and the real rates of return are going to be a lot flatter over time and consistent. Like what people wanted to earn on their money back in, it's kind of fun to look at real rates all the way back to like 1920, 1930. The real rates of return that people expected, have been pretty consistent over time. And it's just inflation that can move you around the nominal rate. And
So like I know a lot of people say about like a generic decent return would be like a 10% return on investment. So like would that be consistent like you were saying back in like the 40s, 50s?
Yep.
Like people were still living for that.
Yeah. Yep. So it's and that can vary a little bit too, depending on the circumstances and the riskiness of assets. So if certain asset classes have become less risky because of information or because of societal change, globalization, you name it, those sorts of factors can have some influence on the real rates of return that are acceptable to people as well. Okay, so now our theories. So we kind of laid out the three: expectations theory, segmented market theory, and liquidity premium, and they're really all just related to each other. So it's not really three theories, it's almost just learning one concept of explaining yield curves. So here's the idea of expectations. expectations, which is what actually expectations will be chapter 7 topic as well. So the expectation theory is to say, let's look at a 1-year bond, compare a 1-year bond with buying a 2-year. I'm going to start you off with just kind of getting your brains going here. So compare a 1-year bond with buying a 2-year bond. So here you've got, if this is time period 0, 1, 2. Obviously, if I buy a 2-year bond, I'm on the hook for the 2 years. And a 1-year bond, I'm on the hook for 1 year. And so as an investment strategy, if I want to be in the game, so to speak, for 2 years, I could buy the 2-year bond, or what would be another alternative, Daniel?
Buy a 1-year bond and buy another one.
And buy another 1-year bond, right? So just keep buying 1-year bonds. So I have a choice of buying 2 consecutive 1-year bonds or buy 1 2-year bonds. Which one should I do? Okay, depends on how much your opportunity cost is, so that's going to have to be factored in.
You could also consider some risk. You could have less risk by doing the 1 year.
The 2 1 year. So this would be an unknown at this point, right?
Yeah.
The red one would be an unknown. The 2-year I can buy with certainty. I'm going to know its rate, and I know I can buy the 1 year, but I don't know this part of it. So there's a little bit of risk there that I'm taking on with trying to figure out if I should buy the second.
It can be more likely to get a higher rate of return than the 2-year one.
That depends on what happens to the market, which nobody knows for sure. So what we do know is that I can basically risk-free other than default risk, which is built into the price. So I'm just saying, assuming I have, especially if it's a government bond, right, there's no default risk. I can buy the 2-year and I will earn this rate of return, or I could do these 2 1 years. And this is the unknown piece. All right, so which one would I want to pick if I knew with, well, let me just leave it at that. Which one would I want to pick? I'm kind of, you said depends on opportunity cost. I think we could even narrow it down further than that, or just get a little bit more specific answer. Okay, so yeah, you want to think about what the future is. So basically, you just want to do whatever's the best interest rate. That's kind of the all I was looking for. I know you guys are like, oh, he's asking something tough, but that's all I'm thinking about is if I expect this one to be higher, which is where Kaylin was going with this. If this one, because I've got this red length of time, but if I expect interest rates to go up, and this is at 2% and this is at 3%, then I can kind of calculate what my expected return is over the time. Whereas this one might be, am I going to get a higher interest rate or a lower interest rate by buying the 2-year versus the 1 year? Higher generally, right? So under most circumstances, so this is 2.5. So maybe it's a game like this, right? More realistically, is like how well do you think that one is going to be? And so you do your calculations, and if this one's higher, do this one. If this one's higher, do this one. But now, if you start doing this one, and everybody on Wall Street starts doing this one because they think interest rates are going to be higher in the future, then what happens in this market, What's going to start to happen over time? Daniel?
The demand goes down for the 2 years, the supply goes up, now it's got the rate up.
Yeah, so there's going to be a market process where they're going to equalize. That's what expectations theory is saying, is that the rate of return for these 2 ideas, these 2 strategies, is going to be equal in the marketplace. So that's what expectations is doing. So let's write that claim down here. So the interest rate on a long-term bond, which is our 2-year in our little example, on a 2-year bond will equal an average of the short-term rates that people expect to occur over the life of the long-term bond. All right, so we'll do a little example. So suppose that the current interest rate on a 1-year bond is 6%. So interest rate on a 1-year bond, oops, use a little notation here. On a 1-year bond, might be for 15 or 16. Let's just say 20. Actually, let's bring it up to about 20. Interest rate for 21. So the interest rate for 21 is 6%. And the expected interest rate for 22, a 1-year bond, is 8%. So again, these are both, whoops, these are both 1-year bonds. Okay, so the expected return of buying these 2 bonds then is the average of the 2. So 6% plus 8% divided by 2 gives me a 7% expected return for doing this strategy as I had here, buying the 2 1-year bonds. So what does the 2-year bond interest rate need to be? What does the 2-year bond interest rate need to be for you to buy it? So anything above 7, so at least 7%. So greater than 7%. Okay, so then I'm going to skip some of the math. I'm going to give you a little bit of it, but your textbook kind of goes through and derives some implications of this to walk you through what I just did. That, as Daniel was saying, supply and demand forces are going to start changing. If the 2-year is higher, then more people are going to be buying those, raising the price, lowering the interest rate, and so these 2 things are going to equalize. And so I'll let you go through some of the details of the math in the textbook, and I'll just give you a couple lines of it here. Maybe I'll give you that summary here first. So therefore, we would predict that the market demand and supply. The D for demand, and then I wrote out supply, I don't know why. So we would predict that market demand and supply would change to equalize these two interest rates. All right, and so in general, here's where I'm skipping a whole bunch of stuff. I don't worry you too much here. This print is getting so small. I wrote these in 6 per page. Okay. I think the text, I'm trying to follow the textbook. The hell? Refuse to get glasses. Oh, I didn't bring that. Oh shoot. Okay. Oh wait. Ah. That's why I have this stuff. Still not being able to show you all of this. Delivery. There we go. INT. That looked like an M with my glasses here. INT. Okay, here we go. Ready. So INT equals interest rate. Oh my gosh, this sucks. Yeah, well, just let me do this, and then I can read it. Actually, here you can just write this right there.
Okay, you can do that in a little bit.
Yeah, so you're having the problem, same problem I have. So it's, I want to write it and explain it is what I like to do. But so IT plus I expected T plus 1, and let's stop there for a second. This is the thing I just did with the 6 plus the 8%, right? So IT, which is time period T. So if time period is 0 is what we usually start off with. Time period T plus 1 is 0 plus 1 is 1 year from now. So the expected rate 1 year from now was 8%. And then we have the 6% today, and then we divide it by 2. But now we're going to keep on going because it could be a 5-year bond or longer. So plus the interest rate that's expected for T plus 2 if it was 3 years from now, plus the interest rate of T plus N minus 1 to get real mathy on you. Fun. So if it was a 20-year bond, 20 minus 1 gives you the 19 years out. And then that's all divided by the number of years, which is 20 if it was a 20-year, or N if we're talking in general. All right, I think I've successfully wrote it down other than my big circle there.
Yes, I got a quick question.
Yep.
So the N minus 1 at the end, that's only because we started with 0 in the first one, right?
Yeah, so we had, right. So it's actually 19, right, that's correct. Okay, so this then is the interest rate of the 5-year bond today, if time period 0. So we're equalizing, so we just did this statement. Should I buy the bond or not? Well, if the expected return of a whole bunch of 1 years is this, then I should do the other thing, right? So that's all we're doing is kind of simple averages. I don't actually totally agree with all of this, but the way that it's just using simple averages, which is part of the reason we abandoned this or not abandon it completely, but abandon part of it as we go to. So, so the key point is that this does not explain why they usually slope upward. So the key point, this theory does not explain upward sloping yield curves. What would be the yield, the look of the yield curve if this theory was correct? Flat, good. That would just be a straight line. So that is the yield curve with this theory. Expectation. Or, you know, and you could test that, at least it would be flat most of the time, but it's not. Okay, so any other further questions on that? So segmented markets. We won't even spend too much time on. It basically says that a 1 year, a 5 year, and a 10 year. Each one of those markets is actually not related to each other. They're all separate. That's what segmentation means, right? We've broken it into pieces. And so I like to think of this, you won't see this in the textbook, this is kind of a Russ Matella special here, is there's a supply and demand associated with the 10 year. There's a supply and demand associated with the 5 year. There's a supply and demand associated with that. So they're not really related to each other. This can be moving around due to certain reasons because people want 10-year assets. And so each one has its own reason for being at the interest rate that it's at. So the key point from segmented market theory is that bonds of different maturities are not substitutes. Bonds of different maturities are not substitutes. All right, so now the mixing of them. If you look back in your notes, what did segmented markets theory not explain very well? That was the last thing I left you with, or what's the last thing?
Doesn't explain points 1 and 2.
Points 1 and 2.
The first one was interest on bonds at different maturities. It says more together over time. And the second one is when short-term rates are low, yield curves are more likely to slope up.
Okay, so that was the interest rates moving together over time. That doesn't really explain that there is some harmony to them moving, or there's some relationship. To just say they're all different from each other doesn't quite explain some of those facts. All right, so here's what kind of both of those, the insights to both of those bring us to liquidity premium. So liquidity premium and preferred habitat. Okay, Okay, so it's going to mix a couple by adding on a term. So now that we've got our, I'm just going to write out the formula because I think it's just a little easier to explain now that I hopefully have it. So I need my glasses. So if we rewrite the formula of the expected I plus t plus 1 expected plus minus the end here plus I t plus n minus 1. All that jazz is the same. And divided by n. So there's some, that makes sense that people are going to be looking at the future expectations and think about how that might play a role in whether it's by long term or short term. But there's also this liquidity premium. So L, oh my gosh, L, yeah, LNT plus LNT. So the NT is just matching the NT here for the longer term bond. This is the liquidity premium, where LNT equals the liquidity premium. For the nth period, bond at time t. And so the key point is that does the premium rise or fall over time? It seems like most of you kind of just implicitly knew this answer without getting into all this theoretical mumbo jumbo. But do you need to get more or less from a long-term bond? More, right? So the liquidity premium rises with time. So LNT rises with all right, so let me go to the board now. Has everybody got writing that down? Okay, so here's the expectations theory yield curve that was flat. And now the one that we just wrote on the board, this sucker, if we were to kind of map it out, we basically have a little number added on to the expectations. And so that's the liquidity premium. And now we have answers to all three of the facts that we were trying to explain. I don't think this gets us real far, but it helps us explain in terms of predictions because, like, well, how does the liquidity premium get formed, right? And that's a little bit about what they're talking about with the preferred habitat. With the preference that investors have, they'll be willing to put some more in. Investors are likely to prefer short-term over long-term, but so that gives us the look, but it doesn't really help us predict better on the interest rates, right? It's just explaining interest rates. Okay, so give that a read, and then we're going to move on to chapter 7. Yeah.
So people prefer shorter-term bonds over long-term yield better, or?
So the yield curve is just showing short-term rates versus long-term rates. So this is the term to maturity, right? The 1, the 5, and the 10. And so your question is, if they prefer, so, and why would that be? Why would investors make a shift to shorter term rather than longer term?
They expect the.
Could be interest rate driven.
Get money.
Get money quicker. For whatever reason, there's a premium on keeping money shorter term rather than longer, right? So if that's the case, and then we could do the kind of the preferred habitat thing where the supply and demand, the demand for shorter term bonds is going up, causing that rate to go up. And so then that would cause this to go up, but this might, the premium might go down here, so it might make it flatter. So they think, usually we think about this one being a little more stable and this one being a little more risky because of us being able to respond to short-term changes. And those bonds are expiring anyway, maybe it's only a 3-month bond. So this one tends to be a little more volatile in terms of how flat or steep the yield curve is. But as investor expectations about the long term start to look better, then the long term can go up too. In fact, that's going to be my next slide here. Here's just kind of general, but here is actual yield curves. These are for government bonds, so this is 0 through 5, and then 5, they broke it here because this is in increments of 1 year, right? And then they broke it, so it's 5, 10, 15, 20 years. And so you can see upward, a little flat, this is 06, 97, 1980, 81, so the 80s, we had those high interest rate times. Still had mostly upward slope, but in 81, inverted yield curve. So I can't remember where I heard somebody say this, but every recession, I don't know if I recite this right, every recession has had an inverted yield curve, but not every inverted yield curve leads to a recession. Right? So every recession has always had an inverted yield curve. So when the yield curve flips up, people are like, oh boy, we might be going into recession, right? But that doesn't happen every time. Every recession has had an inverted yield curve prior to it, but not every inverted yield curve has led to a recession. So it's an indicator of potential recession, but it doesn't always pan out that way. And so we see most of them fairly flat. The 1 to 5s are going to have a little more slope to them. That's yield curve. Any other questions? As long as I remember that, let's put that down in the notes. I don't know if it's in your textbook or not, but I think some professor of mine, or maybe it was somebody else over time. So no. Every recession has had an inverted yield curve prior to it. But a recession has not followed every inverted yield. And so again, here, this is just one indicator of the economy, right? So when we talk recession, we're talking gross domestic product, the dollar value of the economy, incomes, all that. And here we're just talking about bond markets and interest rates. So they're not one-to-one, they just have some sort of connection to each other. That's hard to disentangle. Okay. So that is chapter 6. The books. So chapter 7 kind of follows suit a little bit. We're going to look at rational expectations theory and how that relates to stock prices and the value of stock. So, you know, if we look up, let's see, what stock would you guys like me to look up?
Apple.
Apple. I heard Elon Musk passed Bezos in net worth. South African's the richest guy on the planet. All right, so it looks like Apple's at 129 right now. Guess I'd like to see a. There we go. Here's Apple. 10 a.m. this morning, 129. 6 months worth of Apple, year to date, 1 year. So 129, 130. Where'd that come from?
What,
It's worth 130 bucks per share. Who made that up? Well, it's what people think one share of the company's worth. Yes. Where does that come from? Yeah, people are selling it at that. People are valuing that. How do we? It is a fraction of the company, right? You guys remember how the shares work, right? So if there's 1 million shares outstanding, and so we can find the cap rate of Apple, which is one of the few. Apple and Amazon were the ones that went over $1 trillion, right? So $1 trillion worth of value. That's because they took the number of shares outstanding times 130 equaled about $1 trillion, right? So the value of the company Apple was estimated to be around $1 trillion, which means if you own a single share of Apple, then you are currently able to sell that on the market for $129. Where's that come from? Back in 1974 or whatever, Steve Jobs was in his garage and sold it. Went public. Yeah, so it just naturally grows to 129. Freehand of the market.
It's supply and demand.
So how does a stock get its price? Okay, from what the company's actions are, so you got to dig deeper than that.
So new iPhone comes out, that's revolutionary, Apple stock goes up. Different.
Well, wait, before you do that, if it's revolutionary, what happens before the stock goes up? People buy it. Is there a cost to Apple making them? And so over the course of the year, we can measure Apple's net income, otherwise known in microclass as profit. So we got profit equals, back to not Lynn's fancy way of doing things, but Russ's simple profit calculation. Total assets, no, you're on the balance sheet, on the statement. Profit of a company over the course of 1 year. TR, which is total revenue, which is all these sales that Eddie was talking about with the new iPhone coming out. Oh, it's selling, it's selling, it's selling. So TR minus total cost or total expenses. Total cost. And that gives me the profit for the year. Does the profitability of Apple play into the fact that it's 129 today?
Yes.
Sure it does. Is it an important part of it? Is it maybe almost one of the most important parts of it? It's up there, right? So Why would you buy Apple today? Well, you're hoping that you'll be able to profit on it tomorrow. Now, are they actually going to cut you in on some of this profit? Is Apple going to say they made $1 million and they got 1 million shareholders, so you all get $1?
No, but it indicates the welfare.
Okay, it indicates the welfare of the company. So do some companies give a share of their profits at the end of the year?
Yeah.
What do they call those? Dividends. So we can't have dividend payments as part of a structured payment of certain types of stock. Do most stocks have dividends or not? No. So if Apple's profitable and you want a cut of that profit, what can you do with your $129 stock? Sell it. So you see how the stock price is in some way reflecting the profits of the company for the shareholder. So if they were really profitable and over the course of the next upcoming months here, our stock price went from, over the course of the year, from 129 to 139, then you can sell your share or you can let it run, right? So the continued profitability and expected profitability is all going to play into what that share price is. Okay,
What terms of the company gives dividends?
The owners,
Oh, it's just the owner being like.
yeah, the managers of the company, the CEO, and yeah, board of directors, they can vote on it to have dividend shares or not. So that's usually set ahead of time. So you'll have they'll be identified that way on the ticker tape symbols, or how they identify ahead. You'll have mutual funds that you can buy all stocks that pay dividends or not. And actually, that's going to be one of the first lessons we have next week in that first book we're starting on in Scouts.
And then also, doing the homework, I saw like the stock split. I had a question about like stock split. I had like nothing right, but I was also wondering like, so say I've got a share and
Is this chapter 6 or 7?
Whatever the first one.
The first one? Okay, so it's 6.
If I'm going to share Apple, and then Apple does a 3-to-1 stock split, does that mean I still only have one, but then now mine's undervalued?
We're just going to take that 129 and divide it by 3, and you own 3 shares of that now valued at $40. You'll have 3 $40 shares. Yeah, same value. You don't lose any money. Yeah. And the reason why companies do this sometimes is it can pick up smaller investors. So sometimes, well, like Berkshire Hathaway sells like for $1 million a share for the A-class shares. And so to buy a single share, you need $1 million. They're like, oh, that's not working too well because most people are entry level. So sometimes they like to keep the stock prices in a certain sweet spot. Okay, so that is part of what we're doing here with chapter 7 is looking at where stocks get their price. So let's look at one period valuation. So one period valuation of common stock.
This is chapter 7.
Yeah, this is chapter 7. So if you know that the company is going to give you a dividend, what is your value of the stock today? So let's go back to, let's just stick with Apple. So Apple doesn't have a dividend, right? So the dividend is going to be 0. So how would you value your rate of return of the price today? So you're thinking about buying Apple. You see that it's selling for 129. You're like, should I buy it or should I not? How would you figure out what you think its value is today? Right? Okay, future expectations. So you want to establish what you think the price is going to be a year from now. Let's keep it simple with a 1-period model. So 1 year from now, what do you think it's going to be? Right? And so if you think it's going to be 133, should you buy it today? I like that answer. Why? What do we need to do to the 133?
Find the percentage of the rate of return and figure out what else you have there.
Okay, if you use the internal rate of return approach, you can do that. Or you discount it by your opportunity cost, right? You plug in your own opportunity cost. So those were the two methods that I went over on Monday. So you have the internal rate of return, which has a kissing cousin of the net present value. So to find the present value of 133, so if the stock was going to be that, we want to figure out what is the value today. Let's see, it's zero here, yes. So today is time period 0. We're going to take what we think it's going to be in time period 1 and divide it by 1 plus, and we're not going to use I this time. The book is switching to K. Oh my gosh, that's cold. I had my book here. I want to find this. Yeah, KE. So your book is using a little k, so I got like a little script K. KE is your required return, so your opportunity cost. So we're one time period out, so if I think Apple's going to be 133 and I have an opportunity cost of 10%, I'm just doing our simple present value formula, right? And then I can compare that to the fact that Apple's currently selling at 129. So if this number turns out to be bigger than 129, buy it. If this number is less than 129, don't. And what Daniel is bringing up is that if I plug in 129 here, 133 here, and I solve for KE, that's doing the internal rate of return business that we did just on Monday. Okay? And then I can decide if that number turns out to be 8%, can I get 10% somewhere else, or is 8% okay? Right? So you can calculate it one way or the other.
Is that just like a play on the future value equation?
It is the future value equation. Yes, that's why I'm trying to bring this home. Now, it's using different variables, but PV, I guess just to drive your point home here. That's it, right? This has got a little mysterious 1 right here, which is it's raised to the 1 power. So fundamental equation of finance. It's applied to everything. So that's all we're doing is kind of sneaking that in. Keelan? Okay, you got it now. All right, so then I want to add in the dividend. So with Apple, the way we were saying that, it was nothing, but the dividend in time period 1 would also need to be discounted by your required return. And so
we're using the K for 9 ounces.
yes, and that's just following, your book does the same thing, right? Depending on what we're talking about, it might be a coupon rate, it might be this or that. So this is following your textbook here. And that's what I was going to write next, Kayla. That's where KE equals the required return on investment, which that's what we've been calling opportunity cost. What is your opportunity cost? You need to get at least 8%. You need to get at least 12%. You need to get at least 3%. Each individual investor's number might be different. So it's whatever your required return is on that investment. Okay, so so then if we generalize this model, then we get to our generalized model. So if we go out forever with this, we get today's price discounted, tomorrow's price 1 plus KE raised to the 1 power plus P, oops, I'm doing the wrong thing. I want to put dividend there, not price. Make sure you don't put P1, that goes at the very end. So dividend 1, dividend in time period 2, raised to the 2 power plus dot dot dot, dividend n raised to the required return to the n power. So I'm holding on to Apple for the next 30 years, right? And each year they're potentially paying me a dividend, although, as we just said, it might be 0. And then eventually, Apple will be worth something. And so this last price here is whatever it is in time period n divided by 1 plus k e raised to the n power is the last dividend plus selling the stock. Okay, so if this is far enough out in the future, like if that's 100 years out in the future, like what's Apple going to be worth 100 years out in the future? If we take the present value of pretty much any number 100 years out, how much is it worth today? 100 years out, really, really small. So it's almost going to drop off. So for large time periods, you're really only dealing with expected dividends over time. So for large time periods, I mean, if you start to look, I'll just put an example, like 50 years or more. The final value is close to 0. So then we're really only dealing with dividends. And so that would kind of make this thing collapse into this. Today's stock price is really only based on dividends. Dividend in time period I over 1 plus k e raised to the n power I equal 1 to. So it's like we're just chunking off that. So I'm just kind of saying here, dividend is all that matters. All right, what can I fill in some blanks for you so far here? Is that all right? We're kind of really putting our present value stuff to work. I snuck in a little summation sign here.
Can you explain that real quick, because I see it in a lot of classes, I still have no idea.
Still don't get that? Okay. So I've got the sum. This is just using the Greek symbol of I starting at time period 1 all the way up to whatever is up here. Now sometimes that could be like 10 years, and n would be 10, and you just have a 10 year. So when I equals 1 to n, we've got dividend in year 1 divided by the interest rate in year 1. So that's that part. See how that part is that part? Yeah. And then you've got year 2. So plus, so this says to add those terms after each I. So this sucker plus now this sucker is just means that it's in time period 2 instead of time period 1. And see how the I always matches here with the with what this is. Oh, actually I did screw up. This is the time period I here. My fault, Daniel. That's why you're messed up. That's being raised to the second power. And then the third one will be to the third power, all the way out to the nth power.
So this is like writing all of that.
Shorthand notation. That's all you're doing is for shorthand notation, showing that. Okay, so now we get to the Gordon growth model. So the Gordon growth model. Okay, so what if we do infinity instead of 1? So the price today is really going to be equal to the sum of from time period 1 up to infinity of the D0 or T. Oh, yeah. That's fine. Come back. D0 over the 1 plus the interest rate discounted time period T. And I'm just stopping here for a second. I haven't given you the complete thing. That's why I had to pause a little. If we were thinking about dividends over time, would they potentially grow? So if currently Apple's paying $100 per share, would they be expected to grow over the next 20 years? Yeah, right. With the company grows, the dividend grows, the stock price grows, so the dividend grows. So if we had growth of the dividend by 2% every year, and currently the dividend is $100, what would it be next year? 102. So we got 1 plus the growth rate equals 102, where G equals 2%. I'm just kind of showing you this as an aside before I lay you into that formula. Is everybody with me here? This is how we apply a growth rate, just like an interest rate. But now we're saying that the dividend is going to grow by some amount over time. And so now we can come back and add this into this growth model of 1 plus G raised to the T power. Yes. And I'm going to write that out if I can read it. Okay, so I'm going to write all this out. So DO is the most recent dividend paid. So we look at a company today, the company's paying $100 worth of dividends. So DO is the most recent dividend paid. G is the expected growth rate of the dividend over time. We think it's going to be 2%. We think it's going to be 3%. And then KE is still the expected return. I'll just rewrite it here, required return.
This is a
Yes. And that's one of the assumptions here, that it's assuming that it stays consistent, which is an assumption.
And it does compound, right?
Yes, all the compounding business is all kind of embodied in this. Now, here's the good news as a student. This thing is fairly complicated here. If we start writing, it's got the sum sign. So if we start writing this over 10 years, we've got 10 arguments that are going to look like something like this, but then we've got the growth thing going. Well, a brilliant mathematician was able to boil this thing down into a simple series that this thing, and the proof is in the book, boils down to this. D1, the growth after the first period, and then the difference between KE and G. And your book will show you all the math if you want to get geeked out on it. So the proof is in the book. So to make this equal this, you got to do some mathematical manipulations and show some mathematical beauty of how a series can be boiled down into some things. But this is pretty simple, right? Now you're with me? D1 is 102. So it currently is 100. We expect the growth rate to be 2% at 102. So 102 divided by, I need at least 10%. And I think the growth rate is going to be 2%. 10 minus 2 is 8. 102 divided by 8, I can do some math with that, right? So it's pretty simple way to estimate stock prices based on those variables.
But let's say you're trying to find a stock price in the future, and they give you the growth dollars about the same. You have to calculate the percentage.
The growth rate, you'd have to calculate it's an annualized growth rate. Yeah, and it's fixed over time. So it's an assumption, it's a simplifying assumption. Of course, nobody has a crystal ball, right? So this is all just kind of bringing in kind of different concepts of present value. But what we're doing in this chapter is trying to apply it to stock prices. So if a stock has a dividend and that dividend is expected to grow by some amount, you can poop out today's price. So we can use the Gordon growth model. So this is how analysts would do this, by the way. So Apple was currently 129, right? So then we could go back to this theory, the Gordon growth model theory, put in the numbers, and it turns out to be 127. So should I buy it or not, according to the Gordon growth model?
Yes.
The Gordon growth model says it's worth 127, Apple's currently selling at 129. Then no, right? Or just the opposite could be true. So it gives you just another indicator of whether something might be a good buy or not. And you never put any of your faith into any one of these tools. It's just a tool. It's kind of like using a little estimator of some sort to see what the value is. Okay. So we know that the market sets the price by willing buyers and sellers. So you guys were well trained in my previous classes to say where real stuff comes. So let's put here, I guess we'll wrap up this Gordon growth model is. In fact, I thought I did a little example. Well, that might be in our last thing that we'll do tomorrow. Let's see, so key point. You can use the Gordon growth formula to see if it is higher or lower to the actual stock price. So, question, how are real stock prices set by all right, so then we're back to supply and demand. Apple's currently trading at 129. So this is the shares of Apple stock. We got people on both sides of the market in Wall Street especially. Some of them think Apple's going down. Some of them think Apple's going up. Right? All they're doing is trading positions. So in the thick market, people are going to be forming these expectations from different ways and information, and they're going to trade accordingly. So the key point is traders, let's see, buyers and sellers trade on various information that they have. So some of that information could be personal, and that's what I really like the Skousen book that we're going to talk about next week brings into account why stock prices move. You could be needing to sell your Apple stock to buy a vacation, right? Completely unrelated to whether Apple's going to do bad or Apple's going to do good. You just want to buy a vacation. That's your motivation for selling. So some people are out there, and I'd like to think some of that information would kind of sway one way or the other. And so that's where the focus of rational expectations is going to play on is how, the amount of information people have and who can trade on it or not, or who has access to it or not. So before we, as a way to introduce rational expectations, we're going to start with adaptive. Adaptive expectations. So what's one way that we form an expectation about this Apple stuff? Here it is again. It's kind of small here. I don't know if I can pull it up this way. There it is. It was at 115 back in October, and 129.75 today. Now it was 131 back in September 2nd of 2020. It was higher than where we are today. So where's it going to be a month from now? What's one thing that you can do to try to predict? If you had this data at your hands, what's one thing you might do? Do you see it? Okay, what do you mean by that? Okay, so with trend lines, we're going to maybe do some fancy econometrics that some of you are going to get when we get into our capstone class, right? And so we're going to make predictions. Is it possible that we could have a trend that this is going to be looking like this, and so then tomorrow I expect it to be right here, right? Is that possible? Like, is it I mean, look at we're going all the way back to how far back did I go? Like, I'm doing 1 year, so this is over 1 year. I mean, here's 5 years. I wanted to get real crazy. So, I mean, here's where it was back in 2017. So is it reasonable to make a prediction 1 month out that we should be somewhere in here when we know that 1 month before, here's December. So here's December's trends, 121, we're all in here. Here's the month of December. Is it reasonable to just plug that out? Yeah, in some ways. So it might work for short-term predictions, but is it reasonable to make a 10-year prediction out here? It gets less and less plausible, right, the further out you go with trends. So adaptive expectations is simply using previous experience or past only. So adaptive expectations are formed with past experience or data only. So you might just draw in your notes even a little squiggly line here. Here we are at 129 for Apple, the price of Apple. We can use some fancy statistics or econometrics and try to say, here's our past prices. If that trend continues, then my prediction, my expectation is that it'll be at 133. Right? So this becomes now my expected price formed using adaptive expectations. I'm only using the previous data that I have to form that expectation. Okay, and then I won't even fully do it, but I want to leave you with rational expectations. Rational expectations uses all information. Rational expectations are formed with all available information, which may be current, happening right now. And then we'll leave you with that till tomorrow.